Hi there, it's Bill with Smart Trades, and it's August 2nd, heading into the close around 12:20 Pacific time. And first off, let's take a look at the S&P on the daily chart. And my short-term count for a peak obviously is incorrect, and we broke out to new highs uh, on this current leg up. That leg up looks a little bit like a wedge, although I have some questions whether or not that is indeed the case. But excuse me, um, it's certainly a possibility, and if it is a wedge, the reversal could be rather sharp. That said, let's go ahead and look at the count. I've revised my count a bit. I was initially looking at this leg down as part of a double zigzag off the top, and obviously that's probably not the case, almost certainly not the case at this point because of the depth of the rally back up. That said, the overall pattern, one that this is a corrective decline, an ABC down, and then an X back up, is still intact, and 950 is still my working target, but we're a little ways off obviously, so we'll take that one step at a time. But anyway, the reason I'm looking at this decline as an ABC is that these two legs are of similar magnitude. You can count this as a 1, 2, 3, 4, 5, which I'll show in a moment. But wave 1 is so small relative to the other legs. I think it best counts as a series of ABCs down and then a corrective wave X back up. Now, that said, there certainly are a variety of ways to count it, and I'll be the first to admit that. So anyway, let's go on to the next chart. Here's the 60-minute S&P, and breadth is quite strong here. This chart is from a few hours ago, but nonetheless, the implication of strong breadth was that we've got higher to go. We'll probably, if we are going to keel over, we need to pull back a little bit on the breadth ratios probably first. Usually you do not just roll over with breadth ratios making new highs and going straight up. It does happen, but it's relatively unusual. So if this is a wedge, we're looking at perhaps the 1130, 1135 area for the top of the wedge on the S&P cash, and then a breakdown through this channel, which is going to be a moving target. So we'll have to take it again one step at a time. Here we go back to the S&P cash, and here indeed is that count with 5 waves down off of the highs. And then one thing that's interesting is you can actually, if you do count it that way, you can count that first 5-wave sequence as an A, the rally back up, ABC, B, and then you have a C wave possibly complete. One thing to look at here is we had talked about in late April, early May about the 1030 area, or just below 1030 as being a target because it's the bottom of the previous fourth wave. A little below there around the 1007 area is a 38% retracement of the entire rally off the March lows, and also 0.62 times this first leg down also comes into this general area. So here's a possible scenario where we've already completed this leg of the corrective decline, and perhaps we can call that A. So the rally back up, if that's the case, is a B wave, or it's possible that this is a completed correction here. I don't favor that, as I've said before. I think that the time of this decline is too short. I think there's more to go. But that said, we could possibly evolve into a flat, which would take us all the way back up to near the April highs, or even possibly beyond that. Anyway, I would keep an open mind here, and I'll show you why. Here's the NASDAQ cash, and one of the counts is that's popular right now is that this is a leading diagonal triangle down. Well, the problem with that is that basis the NASDAQ, not only is it not a diagonal triangle to the downside, we made a series of higher lows as we were going down on those first 3 legs down. I think this best counts again as an A, B, C perhaps, or again the prior count where we're working on a double zigzag and then an X wave back up. But at any rate, that said, of note here, if you look at this as a bull flag, we've just broken out above that trend line. Here's again that wedge pattern. It is intact on the NASDAQ. And again, if we do break through the bottom of that wedge, the implication of that is bearish. So we will watch for that and see if it occurs. But for now, let's see how things develop. And here's the weekly NASDAQ. Again, that ABC pattern looks rather clear when you look at it, step back and look at it from a weekly chart. And if you were to connect these lows here, you would see we have a nice bull flag possibly on the NASDAQ weekly, and we've corrected not quite to 38%, which again leaves the possibility, if not probability, that this whole decline is A, we're coming back up in B or X, and we've got another leg down to test this area, perhaps around 1650 basis, the NASDAQ cash. Okay, same basic pattern again. Obviously, this is the spiders, and again, here's our previous fourth wave low. Here's the 38% retracement. We kind of split the difference here, and you can see very clearly the possibility once again of the bull flag in progress. I prefer that it's a continuation pattern with more downside to come, but in the meantime we may rally a bit in B wave or whatever. But the implication of this pattern is that we should be alert to the possibility that we have a completed correction here, or at least a segment complete. And the Russell, again, we have the same basic pattern. Here's that bull flag possibly, and here's the possible wedge. However, there's a problem basis the Russell with the wedge. This second leg up, the middle leg as it were, is longer than the first leg up. Now that's an Elliott no-no in terms of diagonal triangles, and the fact that that leg is longer than the previous first leg up calls the whole wedge scenario into question, particularly in the Russell. But it makes me think and wonder if indeed it's a wedge at all. Once again, let's see how it pans out. Now, here's something interesting. This is kind of under the radar and in terms of Elliott wave analysts, and it's the count in the dollar. Basically, everyone, including myself, was looking at this rally as impulsive. Now, when you step back a bit, and you can see here the clear 5 up, we can call that A. Corrective decline, we'll call that B. Is it possible that this is an ABC rally that's completed, or we have an A equals C scenario very close to the top of this pattern, and again you have two pretty distinct 5-wave patterns up off of the lows from last year, and from that high you have what certainly looks on the surface of it to be an impulsive decline. This is important because if indeed this is an ABC complete up here, the whole scenario of a major deflationary decline in stocks and real estate and so on and so forth has to be called into question a bit, at least in the short term, because the implication of this ABC up, impulse down, is that we've actually got new lows coming up. Now, I think it's too early to tell. This could also develop into an ABC down. However, the depth and the steepness of this decline, and also the very obvious impulsive 5-wave type of pattern to the downside, certainly calls into question the idea that this rally up was impulsive, and particularly since it does break down into 3 waves, at least to my way of thinking. And here we have crude oil, very interesting pattern. I believe this is an ABC rally back up, and we've broken down out of a larger wedge. Now the target for this ABC pattern back up, both in terms of what is a bearish flag and an Elliott ABC, would come in around the 83, 84 area. And so worth watching here. If we were to falter up in this zone around 83 or 84, it's possible this entire rally is a corrective rally, and it may be terminating towards the end of the summer, which is the classic scenario where they squeeze every little penny they can out of the middle class before the larger fundamentals take hold. And let's look at that larger picture. In crude, you can see again that wedge pattern going up, and very clearly when you look at it on a weekly chart, this looks like a bear flag. Now we have to break through the bottom of B to confirm the flag, but worth watching again around that 83, 84 area for short-term patterns that you might want to sell into, or certainly get out if you're long. But again, we'll see it as it comes. Okay, this I find interesting. This is my chart that I posted back on the 27th, and I was looking for a possible peak, and again we broke down out of a wedge. I was looking for the market to fail at resistance up around the 116, 117 area, and then fall through support down around the 1108 area. I'm sorry, that's 1116, 1117 resistance and 1108 support. At any rate, this is what I posted. Now it didn't follow it exactly. Here's the actual pattern that developed, and you can see we rallied up, and indeed the pattern back up, although not exactly what I had anticipated, certainly looked corrective at that time. And from there, similar to that crude chart, we broke down, and then we formed yet another flag to the downside. And ultimately that flag was taken out, but we never did take out either the highs of this first corrective move or the highs of the move. And what I would bring your attention to is that basically in a scenario like this off this 10-minute chart, you can sell the breakouts of the bottom of these bear flags, or you could be more aggressive and actually sell the tests of the resistance at the top. In each case, you had ample opportunity to bring your stops down into the black, and indeed here we have a bull flag that develops. We are going down out of these short-term bear flags, and then the whole pattern turned into kind of an ugly but nonetheless pretty clear bull flag. And within that bull flag, another bull flag developed, and yet another on the breakout. If you're not familiar with playing these kinds of breakouts or looking for these kinds of patterns, it's definitely worth studying these charts. These are Elliott patterns as well. You can count the ABC decline here. But sometimes Elliott's a bit of a curse. It has you looking for very specific patterns and outcomes, when sometimes it's better simply to play these short-term patterns and not worry so much about the Elliott pattern, but you have short-term, very low-risk scenarios where you can play these breakouts or these tests of these bull flags and bear flags and get to a point where you have a free trade. In this case, as on the way down, you could play again the breakdowns, bring your stop to break even, take a partial profit, and do it all over again several times. And if you're looking for, whether you're looking for S&P 950 or S&P 4, as some folks are, if you can get in to the market with low risk, bring your stops to break even, that's what it's all about. It's not so much about being right. We obviously want to be right about the market, but it's more about controlling risk, because no one's going to be right all the time. And when you're wrong, it would be nice if possible to actually get out with a small profit or a break-even trade, and certainly not to lose too much. And these very short-term patterns are really helpful in doing that. Anyway, thanks for watching. We're going to watch as this thing develops. We've got a possible turn coming up, but we'll let it develop. Anyway, have a great week if I don't talk to you. Bye-bye.